Toronto's real estate market is heading for major changes in 2025. A rise in unemployment rate, investors fleeing pre-construction condos, crackdowns on short-term rentals. These are just some of the factors that are going to influence our market heading into the next year. Immigration targets are shifting, interest rates are fluctuating, and new government policies are on the horizon. But what does this mean for you? Whether you're buying, selling, or investing, I'm breaking down everything that's happening and how you can make the most of these changes. Hi everyone, it's Elon from the Portnoy team, and for the last decade plus, I've been helping people navigate one of the most competitive markets on the planet. In today's video, we're going to be talking about three main topics. Where are we now? Where are we headed? And what does it all mean for you? We'll cover immigration, housing supply, interest rates, rental trends, unemployment rate, and even government policies. Stick around until the end for my top tips on how to get ahead in 2025. And as always, if you get any value from these videos, hitting an early like and subscribe is much appreciated. Let's dive right in. In November 2024, home sales surged by 7.7% month over month and over 30% year over year, resulting in the highest number since April 2022. This uptick is largely attributed to the Bank of Canada's recent interest rate cuts. As of November 2024, the Bank of Canada's interest rate is at 3.75%, down from a peak of 5% earlier this year. So why have we seen sales pick up but the prices haven't surged yet? It's a matter of inventory. We have 6.5% more listings now than we did the same time last year, which means that buyers are taking a more cautious approach. We still have a stress test in effect which continues to limit affordability. This means that buyers need to qualify at either 5.25% or 2% higher than their actual effective rate, whichever of those two happens to be higher. This means even with lower interest rates, buyers still need to be able to prove that they could handle higher payments. When it comes to real estate, the biggest game changer is interest rates, and they're driven by inflation. The good news is that as of November 2024, inflation is at around 2%, which is right where the Bank of Canada wants it. Why does this matter? Inflation spiked post-pandemic because demand outweighed supply, and as a result, the Bank of Canada raised rates in order to cool things down. Now that inflation is under control, the rates have been on the way down, but the Bank of Canada wants to be very careful in case inflation starts spiking up again. Whether you're thinking about purchasing your first home or making your next big move, this is the kind of trend to watch very closely. Okay, so let's talk about what's next. Based on the data and my own experience, here's what I think we'll see in 2025. Many are speculating that the Bank of Canada is going to continue dropping rates into next year, but a lot of people speculate it's going to get under 3% to something like 2.75. I personally disagree with that, and there are two main reasons. Number one, inflation control. While inflation is improving, it's definitely not by any means under control. The bank has to be careful not to lower rates too quickly and risk prices rising again. Number two is global alignment. The United States Federal Reserve said that they're probably going to hold rates steady for the foreseeable future, and Canada tends to follow suit in order to avoid currency fluctuations. For some perspective, let's take a $750,000 home. Its mortgage is going to be close to $4,000 at today's rates, but if the rate drops to something like 3%, it's going to be closer to $3,500 a month, and obviously that $500 a month is a big deal to a lot of buyers and homeowners. On the supply side, inventory has been creeping up but is still far below where it needs to be. Toronto's housing inventory is projected to rise by 13% in 2025, mostly due to delayed pre-construction completions as well as more listings hitting the market. Toronto is set to see a rise in pre-construction condo completions by 15% in 2025. The main reason for that is overcoming labor shortages as well as increased construction costs. There is a twist to this though, because investors who have been a large force driving the new construction market in recent years are actually not in the market anymore, and nobody truly knows when they'll come back. Developers are facing big challenges like canceling projects altogether in some cases due to this decreased demand and rising costs of construction. Let's move on to a massive factor in immigration, which has been a significant factor in driving the housing demand in Toronto. Canada had ambitious targets of welcoming 500,000 new permanent residents per year. However, as of late, they've decreased those targets to around 395,000 for 2025 and even less for subsequent years. Among many problems that we faced with the immigration levels of the last few years, our infrastructure just can't handle it. The government knows this and wants to slow things down to give the cities a chance to catch up. Immigration has been great for economic growth, but bringing in too many people too fast has made it hard for the government to invest in other things like social services and housing. By slowing down immigration, the government hopes to create a balance where they could grow the economy but also make sure that everyone including newcomers, has access to housing and social services. So obviously, this reduction helps to alleviate housing affordability and infrastructure strain, but it might slow the economy as it does. At the same time, immigrants contribute significantly to the labor force and consumer base. This, of course, can potentially affect the broader real estate market as a whole. 2025 is also a federal election year. Historically, these years bring about big changes which can have vast implications for the future of the housing market. An example of such a government policy is something that's taking place around now, or at least the time I'm filming this. December 15th, 2024 will bring about some new changes and measures that should impact affordability. First up, the maximum property value eligible for insured mortgages is increasing from 1 million to 1.5 million. So what does that mean? That means buyers in pricier markets like Toronto can qualify for homes up to $1.5 million by paying less than 20% down, which will alleviate a lot of pressure and make it less daunting to save up for that down payment. But here's the flip side, this could also drive up demand, especially for mid-range properties, which means even more competition in an already tight market. Another big change is the opportunity to raise your amortization from 25 years to 30 years if you're purchasing a new home or if you're a first-time buyer. This lowers your monthly payment, which is great for affordability, but keep in mind it also increases the amount of interest that you'll pay over the term of that loan. So it's a trade-off, but for many, it's a step closer to home ownership because without it, they might not have been able to afford a home now in the first place. In addition to buyer-focused reforms, there's also talk of zoning reforms to encourage high-density development in urban areas. This could help alleviate some of the shortages in cities where demand outweighs the supply. Along with that, the government is cracking down on short-term rentals with its $50 million short-term rental enforcement. This fund is designed in order to help cities crack down on apps like Airbnb and Vrbo in order to bring more supply to the long-term rental housing market. For renters, this could alleviate their issues by increasing the supply of available rental units and also potentially stabilizing in costs if enough of them hit the market. If you're looking to rent, this could help you by bringing more rental units to the market, obviously giving you more options, and if enough of them come to the market and supply truly does increase, then prices might stabilize as well, which is always good news. An often overlooked but critical factor in real estate is also the unemployment rate. As of December 2024, Canada's unemployment rate is at a whopping 6.8%, and Toronto's is even worse, standing at about 8.1%. 8.1% of people are unemployed in Toronto as it stands right now. When it comes to mid-tier and luxury property, this definitely dampens demand, which could lead to price stabilization or even price reductions in certain areas. Conversely, if you're not buying, you still need to live somewhere, so what happens to the rental market during these times? It tends to rise up. Despite all of the government measures that we talked about before that are in theory supposed to help first-time home buyers, the unemployment rate is critical because if they're not working and making the money to afford housing in the first place, none of that truly matters. Personally, I definitely think that we're in a time of transition. Immigration, unemployment, government policies, all of these things make a really unique but really tricky environment as well. If you are thinking about buying or selling, it's crucial to assess your current financial stability and long-term goals in light of everything going on. More than ever, having a strategic plan on getting into the market and keeping your costs reasonable is very essential. By the way, if you're interested in what the upcoming election means for housing specifically, we did a full video breaking it down and what each party's intended plan means for you, so make sure to watch that here. If you found this video helpful, make sure to like, subscribe, and share this video with someone looking to make their next move. So let's get the conversation going in the comments below. Where do you think the market is headed to? Are prices going to go up, drop down, maybe even stabilize? And if you have any questions surrounding Toronto real estate as a whole, make sure to drop them in the comments and I'll do my best to answer each one. That's going to be it for us. Watch our next video here and take care.